Howdy folks, it is Dr. Jeff Camarda with this month's A Word from Jeff called Investors Building Retirement Portfolios Have Many Choices. So let's talk about those choices. They can consider stocks and bonds in typical, traditional savings accounts, certificates of deposit, real estate investment trusts or REITs, an index fund, mutual funds, and many others as they look to build a diversified portfolio using asset allocation. Annuities, whole life, and other insurance company products can add to the mix. This can get very confusing, however, especially considering the impact of changing interest rates, the needs for guaranteed income, setting up the right retirement account, and what happens in the stock markets. Always unpredictable. Ever up over the long term, but near term always unpredictable. As one reviews and builds sources of income from Social Security and elsewhere, both short-term, long-term, and other cash flow impacts on the nest egg need to be deeply considered. For CDs and especially bonds, maturity dates can be critical and should be scrutinized. As most of the rest of this article will highlight, though, bonds may not be a good choice to keep or buy going forward. Barron's, no less than Barron's, recently headlined that Treasury bonds are now riskier than stocks in the respected up and down Wall Street column. It said the S&P 500 dividend yield is nearly 2%, while the 10-year Treasury yields 1.55, making a rare time when stocks yield more than government bonds, according to Barron's. Of course, it's also true. Looking at stocks with attractive dividends now can be pretty alluring in a world of low interest rates. For instance, at the time that I wrote this, the iShares Select Dividend ETF, which I'm not recommending, just an example, pays nearly 3.5%. Value hounds targeting high payers can do even better if they look for individual stocks, as does Camarda's Caesar portfolios. For instance, Exxon, which we don't own to make for an unconflicted example here in the video, pays nearly 5%, and many familiar names pay even more, some yielding 6.5% or even more. Of course, stocks are not without downside risk. Stock investors should be prepared to stay in it for the long haul, since time tends to damp out the volatility and price swings over the long haul. Longer holding periods are generally therefore safer because of this, this volatility damping effect and reversion to the mean over the longer term. But at this point in the cycle, bonds can be as much, if not greater risk of market crash type conditions, and probably without the upside of stocks. I would say almost certainly, in my opinion. But with the current economic conditions, building retirement portfolios around strong dividend income can be a good bet, offering not only attractive payouts, but nice appreciation potential as well. Value stocks, the kind that Warren Buffett talks about and invests in, which can be had on the cheap and which often offer nice dividend payments, have gotten really beaten down over the past 10 years compared to growth stocks and even indexes like the S&P 500, which have a ton of growth stocks in them. While there have been some signs of a value turnaround lately, cheap stock investing has fallen so far out of favor that many fans have given up or disappeared, which could be a sign of opportunity since so few have been buying lately. Some pros, Camarda included, feel there's a lot of great buys lurking in this space. We see some companies that we think are really just wonderful that still seem to be on sale. Foreign stocks, foreign value stocks, may offer even more opportunity. They have gone down a lot more, and many offer attractive dividend yields. Many of these yields are even higher than U.S. rivals. Besides the higher income stocks, the higher income the stocks may offer, these stocks can potentially provide even more profits for patient investors. Stocks and sound companies can be expected to rise over time, but bonds are generally flatline investments which don't grow much aside from interest rate considerations. The long-term trend for stocks is generally up, but for bonds flat. In periods of low interest rates like now, one might predict that the trend for bonds is down. As interest rates go up, the value of bonds goes down. But for periods of rising rates, as I mentioned, the trend can be very scarily down. We think that value stocks offer superb opportunity in the current environment, which is why we're so excited about the potential for Camarda's Caesar individual stock strategy, and suggest that you consider it if you're not already deployed to it. Thank you so much for watching. Until next time, this is Dr. Jeff Camarda. Bye-bye.